You've seen them, right? These huge companies with massive factories, fleets of trucks, shiny office buildings. But have you ever stopped to wonder how they actually account for those giant multi-million-dollar purchases? Because I can tell you it's way more complicated than just writing a check.
And that really gets to the heart of the matter. How does a company take this massive, long-term thing, a factory, a fleet of vehicles, that's going to create value for years, maybe even decades, and tell an accurate financial story about it year after year? Well, that is exactly what we are going to break down. The easiest way to think about this whole thing is to see an asset's life as a simple three-act story. Act 1, it's bought. Act 2, it gets used to help the business make money. And Act 3, it's eventually gotten rid of, sold, traded in, or just tossed. So let's walk through each of these acts one by one. All right, let's start right at the beginning. Act 1, the purchase. This is all about figuring out what an asset really costs when you first buy it, because, spoiler alert, it is almost never just the sticker price.
See, there's this really fundamental rule in accounting called the cost principle. And the idea is powerful but simple. You have to record an asset at its actual cost. And that actual cost means every single penny you had to spend to get that asset in place and ready to start working for you. Buying a piece of land is the perfect way to see this in action. You might think the cost is just the purchase price, but no way. As you can see here, you also have to add in all the legal fees, the transfer taxes, the cost to tear down some old building that was on the property, and even the fees to get it surveyed. All of that gets bundled together, and that becomes the official cost of land on the company's books. Okay, so we've bought the asset and it's on the books. Now it's time for Act 2, the useful life. This is the long middle part of the story, right? This is where the asset is actually doing its job. And the big question for accountants is, how do we account for its cost over all that time? Let's get specific with an example we'll use for this whole section. A company buys a truck for $41,000. They figure they'll get about 5 years of use out of it. Now, it wouldn't make any sense to report a huge $41,000 expense in year 1 and then zero for the next 4 years, right? That truck is helping them make money that whole time. So how do you spread that cost out fairly? The answer is this super important concept called depreciation. And listen, this is key. Depreciation is not about the truck's market value going down. It is purely an accounting process. It's a system for allocating the truck's original cost over its useful life. Think of it like this. You're matching the expense of using the truck with the revenue that very same truck is helping you earn in that period. Now, here's where it gets really interesting. There isn't just one way to do this. There are a few different methods for depreciation, and each one tells a slightly different story. Straight line is the simplest. You expense the exact same amount every year. Units of production is all about usage, not time. And then you have double declining balance, which is an accelerated method. It lets you record more of the expense in the early years. And this chart just shows the difference perfectly. Just look at the bars. Straight line, that's the blue one, is totally flat, a steady, predictable expense every single year. Units of production, in red, well, that one bounces around depending on how much the truck was driven. And then look at the green one, double declining balance. It starts really high and then gets smaller over time. But notice this, at the end of the day, the total expense is the same for all of them. It's just the timing that's different. And that brings us to the end of our little three-act play. Let's move on to Act 3, the final chapter. Because eventually, the asset's useful life is over. It's time to sell it, trade it in, or maybe just haul it off to the junkyard. So when it comes time to get rid of an asset, there's a pretty clear 4-step playbook. First, you have to get the depreciation all caught up to the date of disposal. Then, you wipe the asset and all its depreciation off your books. Third, you record whatever cash you got for it. And finally, the fun part. You figure out if you made or lost money on the deal. And that calculation all boils down to the simple formula you see on the screen. You just compare what you sold it for, the sale price, to its book value. And the book value is just its original cost minus all the depreciation you've recorded over its life. If you get more cash than what it's worth on your books, hey, that's a gain. If you get less, it's a loss. Simple as that. Okay, so we've followed this asset all the way from the purchase to the very end. But let's be real. Why does any of this actually matter? Why should investors or managers, or why should you care about all these accounting rules? It matters because this is how these huge investments actually show up on a balance sheet, which is one of the most important financial reports a company puts out. You can see it right there. There's the original cost of the buildings and furniture, and then right below it you see less accumulated depreciation. That final number, property, plant, and equipment, net, is the direct result of that entire three-act story we just walked through. And we can go beyond just reading the financial statements. We can use this information to analyze how well a company is performing. A great tool for this is the asset turnover ratio. It basically tells you how efficiently a company is using all of its assets, the factories, the trucks, the whole shebang, to generate sales. And a higher number here is definitely better. It means the company is getting more bang for its buck.
So, I want to leave you with a final thought, something to chew on. It is perfectly legal and actually very common for a company to use one depreciation method, like the simple straight line one, for their reports to investors, but then use a totally different accelerated method when they file their tax returns. They are telling two different stories with the exact same assets. So why would they do that? Just think about it for a second. What is a bigger expense in the early years due to your taxable income?